Thanks, Dean, and thank you all again for joining us for the 2026 Halftime Report. My name's Aaron Von Aus, Wealth Advisor here at Flagship Financial, and I'm excited to be here today presenting to help you better understand what happened in the markets in the first half of 2026 and what may unfold in the months ahead. But before we get started, there's just a few housekeeping items. First, if you have questions, please ask. We will have dedicated time at the end of the presentation for a Q&A session. But if you think of something along the way, please ask by using the chat feature. You should see a chat icon in your menu, and when selected, you can enter and submit messages or questions directly. Second, I want to draw your attention to these disclosures. Please just take a few moments to review and let me know if you have any questions. So now for the agenda. Today, I'm going to focus on 4 key areas. We're going to review the first half of the year in the U.S. markets. We'll take a look at the potential market forces in the second half outlook. We'll attempt to answer the question, well, where are we now? And finally, we'll take a look at what's ahead for the remainder of 2026. So let's begin by reviewing how the stock market performed in the first half of 2026. The first half of 2026 has been defined by resilience in the face of disruption. The outbreak of the Iran war introduced uncertainty, driving energy prices higher and forcing a reassessment of the Federal Reserve's policy path. Yet through it all, the U.S. economy has held its footing. Growth has remained positive, the labor market has stabilized, and consumer spending has stayed solid. The conflict that many feared would derail the expansion instead revealed its underlying durability. Here's a snapshot of the S&P 500 index. We use the S&P 500 index because it is widely considered a representative measure of the U.S. stock market. The S&P 500 trended lower in the first quarter before recovering throughout. 2 dominant themes shaped the first half of the year: developments in the Middle East and continued enthusiasm surrounding artificial intelligence, or AI. As shown in the chart, stocks traded largely sideways during much of the first quarter before declining in March. Escalating conflict in the Middle East and the subsequent closure of the Strait of Hormuz weighed heavily on investor sentiment. At the same time, the economy was beginning to show signs of improvement. However, the resulting oil shock from the Strait of Hormuz disruption impacted global economic activity and contributed to a rise in year-over-year CPI inflation to 3.8% in April and then 4.2% in May, the highest level in 3 years. Subsequent June CPI data cooled to 3.5%, the first decline in 5 months. Market sentiment began to improve towards the end of March as geopolitical tensions eased, and combined with resilient economic data, strong corporate earnings, and continued enthusiasm surrounding AI, these developments helped fuel a powerful second quarter rally, with the S&P 500 gaining 14.9%, its best quarterly performance since the second quarter of 2020. So we've talked a bit about how the S&P 500 performed so far this year. But how does that compare to expectations? At the end of each year, Wall Street analysts share their predictions for the year ahead. And this table shows several of those 2026 projections at the end of the prior year, 2025. How do those predictions compare to reality so far? The S&P closed at 75.48 on June 30th, 2026. At the close of last year, the S&P closed at 68.46. That's a 10.3% return during that period. So let's take a look at how those Wall Street analysts' predictions are holding up this year. As this chart shows, most firms are sticking with their start of the year forecasts. A few have adjusted higher and one has adjusted lower, but most remain unchanged. Now, estimating where the S&P 500 will be at the end of the year is always challenging, especially in 2026 given the uncertainties of the Middle East, inflation, and the expanding AI trade. But for the most part at least, most firms are comfortable with their outlook, and the average group forecast is 77.16. So let's shift gear towards the second half outlook. In the following slides, we'll discuss the factors and the historical trends that may impact stocks in the second half of the year. To create some context about where the economy may go in the second half of the year, let's start by looking back to June 2025 and some of the key economic and financial indicators. We picked June 2025 because it takes us back to when the tariff negotiations were in full swing. A year ago, the majority of economic and financial indicators, and 16 of the 20 were neutral. And only credit availability and fiscal policy were positive, while valuation outlook and geopolitical risk were the only two negative indicators at that time. If you fast forward just 6 months later to December of 2025, the economic outlook had begun to improve across many financial indicators as investors seemed to put the short-term economic impact of tariffs behind them. The number of positive indicators increased to 6, with 4 changing from yellow to green, and only one remained negative, equity market valuation, as geopolitical risk improved from red to yellow. So if you fast forward another 6 months to June of this year, 2026, the indicators are telling a more cautionary tale. The number of green indicators dropped from 6 to 2 so far this year, and 18 indicators are showing a neutral stance compared to 16 a year ago. The takeaway here is indicators can change quickly. And the other takeaway is to remember the old saying, stocks climb a wall of worry. Inflation has been a hot topic in the markets recently. And when determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. And as it works to uphold its monetary policy goals, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps to determine whether or not to adjust interest rates. Now, the Fed has stated it's comfortable with inflation in the 2% range. We're looking at two charts here. One depicts the pace of consumer price inflation on a year-over-year basis, and the other, on the right, shows month-over-month inflation. As you can see in the chart to the left, year-over-year inflation trended higher in March, April, and May as higher oil prices from the Middle East conflict rippled through the global economy. Month over month, it was a similar story. And as I stated prior, June inflation cooled a bit to 3.5%. Now, as we get deeper into 2026, we'll start to see if the recent CPI reports were outliers. But regardless, expect the Fed's decisions on monetary policy to continue to influence the financial markets in the second half of the year, as new Fed Chairman Kevin Warsh focuses on Fed policy changes and price stability, and more clarity emerges on the Middle East conflict's impact on inflation. Now let's take a look at the labor market, as the labor market continues to demonstrate its resilience. And this vitality has provided important support to the markets, since having a job is fundamental to consumer spending. And consumer spending has historically driven about 2/3 of U.S. economic growth. Now, the strength in the labor market may be best illustrated by two measures: current job openings and the unemployment rate. While the number of job openings has fallen since its post-COVID peak, the percentage of companies unable to fill open positions remains elevated compared to the 2016 to 2020 period and has been trending up so far in 2026. The unemployment rate, meanwhile, continues to remain at historically low levels thanks to continued private sector hiring. Now, these are just two of the indicators economists use when measuring the health of the labor market. While market pundits and others may talk frequently about oil prices, CEOs don't necessarily discuss the price of oil on quarterly earnings calls. But it has come up more and more in shareholder conversations since the start of the year. On quarterly calls with shareholders, the phrase oil prices was mentioned by CEOs 149 times in the first quarter of 2026. That's a 176% increase compared to the fourth quarter of 2025 when it was mentioned 54 times. Investors want to hear how oil prices are affecting the global economy, inflation, and companies specifically, and how those companies are adapting their business strategies accordingly. Now let's examine the present before we dive into what the future may hold. Now let's take a moment to consider the issues that may weigh heaviest on market performance during the second half of 2026. The first is the Middle East, which has impacted large sections of the economy both here at home and around the world. If peace talks succeed, this is one headline you may see if all parties agree to permanently reopen the Strait of Hormuz. Which leads us to the next potential headline. Even if peace agreements come quickly to the Middle East, inflation will remain a threat to the economy despite the Federal Reserve's best efforts to contain it. If the Fed does adjust rates, the change is likely to have ripple effects throughout the economy. And finally, artificial intelligence may once again drive headlines, especially if it moves into a new phase. Now, of course, no one can predict what will happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. So let's take a look at potential forecasts for the second half of the year and beyond. Let's now look at what market strategists think about the direction of the stock market over the next few quarters. Some market strategists look at the bottom-up earnings per share, or EPS, to help set their price target for the S&P 500 index. And when setting a bottom-up target, strategists focus their attention on estimating earnings for all S&P 500 companies. And by contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making such a forecast. This chart shows the bottom-up EPS and the price of the S&P 500. And notice how stock prices have been trending higher and at a steeper pace compared with corporate earnings over the past 3 months. This type of analysis shouldn't be seen as a perfect predictor of stock price performance. And when evaluating this chart, it's important to remember that the stock market is considered a discounting mechanism, which means it's always looking forward. Put another way, the stock market's price today represents all available information, current and future. How far forward-looking is the stock market? Most would agree its discounting activity is 6 to 9 months into the future. So are stock prices seeing a turnaround in earnings? That's uncertain and only time will tell. Now, considering the importance of corporate earnings to stock valuation, the big question for investors is what can we expect for future corporate earnings? If you take a look at this chart, you'll notice that earnings for 5 of the 11 industry sectors in the S&P 500 are expected to grow at a faster clip year over year in second quarter than they did in Q1. And fourth from the left on this list is the overall year-over-year Q2 earnings growth projections for all S&P 500 companies. And some sectors are expected to do better, while others are projected to lag. Earnings growth projections are slightly higher for all of 2026, with analysts projecting 22.1% growth in earnings for the entire calendar year. To gain better insights into how economists think the economy will perform, we take a look at the May 2026 Survey of Professional Forecasters, conducted by the Federal Reserve of Philadelphia. Let's look specifically at the consensus forecast for three key economic factors that may influence the market's perception of the state of the economy. They are GDP growth, unemployment, and inflation. As you can see in the charts, the consensus view as of May 2026 is that GDP growth is expected to be between 1.5% and 2.4% in 2026. Meanwhile, professionals are projecting that the unemployment rate will remain between 4.3% and 4.8%. And finally, these professionals also expect inflation, as measured by core personal consumption expenditures, to be between 3 and 3.4%, up a bracket from last year. Now, future progress on managing inflation may be a bit more difficult. One aspect of inflation is what is called sticky inflation. And sticky inflation refers to the components of the consumer price index that have historically exhibited a greater rigidity or stickiness with respect to price changes. Sticky inflation includes many service-based categories. Think medical services, education and personal care, as well as most of the housing categories. Now, in recent years, the Federal Reserve has commented on stickiness in service-related inflation as one reason for remaining vigilant in its fight to lower inflation. As you can see in the chart, while the Atlanta's Fed measure of sticky inflation has been stubborn, it has moderated over the past 2 to 3 years and has moved closer to flexible CPI. Needless to say, the Fed has much to consider as it evaluates monetary policy going forward. Among the biggest questions investors have heading into the second half of the year is, will the Fed adjust interest rates before the end of the year? Now, in its June meeting, the first under the new Fed chair, Kevin Warsh, the Fed held rates steady for the fourth consecutive time, while 9 of the 18 officials penciled in at least one rate hike before the end of the year. Inflation, running at 4.2% over the past 12 months, remains their central concern. The next few meetings of the Federal Open Market Committee may answer some questions and provide additional clarity for investors. Now, the FOMC is scheduled to meet 4 more times in 2026. They meet next week and then again in September. Their September meeting includes an updated summary of economic projections. Now, typically the Fed, if they're going to make an adjustment to interest rates, they do so by announcing the change following their 2-day meetings. And only in extraordinary circumstance do they announce a change to policy between those meetings. Here's another important relationship to understand, specifically in the bond market. Bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, existing bond prices generally go down and vice versa. After experiencing years of low interest rates, some investors may be surprised to realize their bonds can lose money if they are sold before they reach maturity. Bond values may decline during a period of rising interest rates, but a changing tide in the economy doesn't mean you have to abandon a fixed income allocation, as often this movement is an important part of a well-balanced and diversified portfolio. and also may provide investors with income they need. Now, diversification is an approach to help manage investment risk. It doesn't eliminate risk, but is an important component of a well-balanced portfolio. Now, tuning out headline noise while managing your finances is not always easy, especially in the world we're in now. However, wise investing involves more than reacting to headlines that may discuss things like consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on the fundamentals, things like company earnings and economic data, as opposed to headline risk. Now we've gone over a lot today, but I'd like to conclude with a longer term perspective on the financial markets. And having this perspective, I think, is key when pursuing the financial goals that we set for ourselves. So there's been a lot of volatility lately and uncertainty this year. But despite a rough first quarter, stock prices have recovered as diplomatic efforts continued in the Middle East. And all three major market averages are up considerably for the second quarter, with the S&P 500 and NASDAQ posting strong double-digit gains. Now, this chart shows daily historical performance of the S&P 500 index through U.S. bull and bear markets from the late 1960s through the first quarter of 2026. As we can see, the market expansions and recessions over 84 years can help put things in perspective. The reward of growing an innovative economy often goes to investors who remain disciplined and remain invested over the long term. And knowing when to look past market noise in order to remain focused on those long-term goals is key. Now, the overall outlook remains constructive but more nuanced than it appeared entering the year. The economy is on solid ground, earnings have surprised to the upside, and credit markets remain calm. But the margin for error is narrowing, and diversification may matter more in the second half than it did in the first. And now, as I've said, we've gone through a lot of information here, and I'm sure many of you have lingering questions. Remember, if you're wondering something, it's very likely someone else is in the audience as well. So at this point, we'll open up our Q&A session, and we'll be happy to answer anything on your mind.